Hello, Nick Redfern here. For anyone that doesn't know me, I was having a chat with Ursula a little bit earlier on, and there's some work that I've been doing on cold calling and trying to find ways in which we can get a better result when we contact customers over the phone. Many different ways of trying to do it. Knowing them first and having some sort of engagement makes them a better chance of obviously getting hold of them. However, if you do obviously just pick up the phone to someone you haven't spoken to in a while or someone that is on a specific cold call, it's important that you can very, very quickly get credibility with that customer. So sometimes the issue is that what I'm trying to do is call people to essentially just get myself a meeting. And sometimes what that can lead to is that the quality of the meetings that we're getting aren't particularly great. Also, if we contact people and we go straight into a kind of selling mode, trying to say, look, I've got this feature, I've got this feature, I've got this feature, it can often just switch people off. So one of the things that we want to try and do in the first instance is try and engage these people so that they actually want to listen to us before we even start to try and kind of tell them about the product or what we have. I mean, there's almost a point where, in certain circumstances, we're not going to tell them everything we do. We just kind of want to get them hooked on a specific thing. So I'll give you an example of how that might happen by humbly trying to do a role play with myself and see how it goes from there. On the left-hand side here, what we've got are a number of USPs that we have for our business: 0% contract, direct offer support, occupational licensing. Okay, but for instance, if I'm to phone someone up and say, look, we do occupational licensing, the guy's not really going to have a clue about what I'm talking about and what the benefits and what the impact of that is. So what I want to do is I want to give him an insight and a story around what we're trying to achieve with our business, which then leads on to the features and the benefits of actual occupational licensing. What it also does at the same time is it differentiates you away from other cold callers, other people calling that are just trying to get a meeting. It differentiates you away to a higher level of knowledge. And if you are seen as useful and valuable, people are more likely to want to listen to you, have meetings with you, and the likelihood is you're going to close more calls. So I'll give you an example of that. So someone rings up, hi, the name's Nick Redfern, I'm calling from Regional Sales Director, calling from True Potential. How are you? Could I get 5 minutes of your time? And the customer says, yeah, no problem, I'll give you 5 minutes of your time, but what's this call about? And I say, okay, well look, would you mind if I just gave you a little bit of an insight first into what's going on in the market, and then from there I can explain more about what we're about, just to try and give this call a little bit of context. Could I just ask you a few questions, if I may? First question, do you do much occupational business? Do you understand about this market? Is it somewhere that you're getting involved in? Yes, it is. It's somewhere that I'm getting involved in. I'm aware of it. Okay. I mean, I have to say this is something that's very keen on our radar right now and something that we've been working with. Let me tell you a little bit about that. Obviously, right now, you'll know being a financial advisor, that it's never been a better time for the UK consumer to consider at least looking at their occupational scheme. I mean, there's £500 billion worth of deficits on these schemes right now. And what this means is that many of the large companies with these schemes are trying to offload them to get them off the balance sheets because they are going to affect future profitability of the businesses. In addition to that, gilt yields and interest rates have never been at a lower level. And what this means? Well, it means that obviously some of the multiples that we're seeing coming through are absolutely huge right now. So we've got advisors doing business with customers where it's 40, 50 times multiples on what they would have got as an annual income from that. And in some of these situations for these customers where they weren't considering it before, it's a no-brainer. Now, one of the issues in the market is doing this business can and always has been perceived as very, very high risk. What we've done within our organisation is we've actually set up licensing. So we've got AF3 guys, G60 guys, but what we found is if someone's not practicing this all the time, what it can lead to is a lack of understanding of the changes. So just because someone's G60, if they haven't advised someone in an occupational sense in 3 years, the likelihood is you're going to be out of touch, and the likelihood is that the advice might not be as good as it should be. And that's a risk for a business. What we've done is we've set up licensing within our organisation where any advisor is able to take on the licensing and therefore able to advise an occupational business. Let me explain what that's done for our organisation. In the last month, we've processed nearly £20 million worth of occupational DB transfers. Now, don't get me wrong, many of those we didn't transfer, probably around about 50%. So about £40 million worth of business we considered, of which £20 million worth was acceptable to go through. We see this as a massive opportunity for our business, but massive opportunity for advisors, which in many companies, because of the high risk nature of this, are missing out on. Let me give you an example of what's going on in our organisation right now, if I may. From an occupational side of things, what we've done is we've engaged very closely with our PII insurer over the past year. The PII insurer within True Potential now uses our occupational processes as benchmarks for their other clients to meet up to. And some of this work that's gone on has now meant that following a recent FCA visit that we had back in April, that the FCA has de-risked our business and now doesn't want to see us for another 4 years, which is pretty impressive when you consider the sort of size and scale of our organisation, £32 million turnover from an advisory firm. So it's an absolutely great story. This is a small example of one of the USPs we have, some of the things that we do with advisors, and the difference that we've made as a result of that. Could you give me 45 minutes of your time to come and learn a little bit more about what we do here at True Potential, because there are many more areas that I could focus on. Okay, so that's an example of giving someone an insight and a bit of a story in relation to occupational licensing. Let's give someone an example on exit strategy, because there's lots of companies out there offering exit strategies right now. Intrinsic 2.66% if you're IFA on recurring income. If you take an example of if you're restricted with them, it's about 3.2%. If you take an example of SJP, they normally sort of argue we do sort of 6 to 8 times, but that also needs to be considered in relation to the fact that, you know, if you're a pensions guy, you're only getting 25 basis points on the pension, so 6 to 8 is really more like 3 to 4 times. Now, our offer is 5.5 times. It's in effect what they say if an advisor's charging 0.5% ongoing, it's 5.5 times. But it's 2.75% of the assets under management is what we will pay to an advisor. So, like I say, if you're charging 0.5 ongoing, it's 5.5 times. I don't want to say to someone immediately that I'm going to pay him 5.5 times. What I want to do is I want to just have a little bit of a conversation around exit strategies. So I'd say, could I just ask, would you mind telling me what some of your plans might be for the future? Well, I'm looking to grow my business, so on and so forth. Have you considered, one of the first things that we always try and say is, have you got an exit in mind? And have you got a time frame for that exit and building up for it? Which case you might say, yeah, well, not really. I might sell it to another advisor. I might do X, Y, Z. Look, do you mind if I give you a little bit of background on exit strategies and how we've structured ours and why we've done it in the way that we've done it? What you'll see in the market in the main is that most firms, what they're doing is they're getting financial advisors to buy other financial advisors' practices and giving them a loan in which to do it. Okay, so I'm going to give you, Mr. Advisor, some money on a loan to buy this guy's practice. Okay, what that means is the buyout that an advisor is hoping to get in the future is incumbent upon someone being a willing purchaser down the other end of the line. Now, if that individual, those willing purchasers obviously will have to come from younger customers. Younger advisors will have to come through to make those purchases. But we've got a funny situation in financial services where it's very, very top heavy. Well, what we've got is many financial advisors that are sort of 50, 55 and over, considering looking at exits. Yet the number of entry people coming into the market at that age is much, much smaller. in addition to that, a lot of those younger people don't have the benefit that some of the older people had of sort of large final salary pensions. They don't have some of the benefits that they would have had. So are these younger people going to have the capital to be, are they going to have the confidence to want to take on those levels of debt? We thought it was really important that we address that issue within the market. So within our exit strategy, actually what we do here at True Potential is we would look to buy those assets directly from the financial advisors, and we would take that on ourselves. We are not looking for a loan. We're not looking to loan people money. We would be looking to put an underpin in your business so that we would guarantee to buy those customers at a rate of 2.75% of the assets under management. To give you a figure, 10 million assets under management would pay £275,000 as a capital sum there. So just wanted to give you a little bit of insight of what's going on in the market in relation to exit strategies, things that you might really want to consider. And look, I'd love to have a little bit more time with you to explain some of the other great things that we do. Really is fantastic. Could you give me 45 minutes of your time? So again, I'm trying to give some context of the story first, some insight into what's going on in the market before I then bring out and give someone actually what it is that I've got. An example on direct marketing support. I'll give you an example there. So recently what we've seen in the market is many advisors have started to reduce down their client banks. So pre-RDR, I would have a conversation with a firm and say, how many customers have you got? And they might say 600, 700. Post-RDR, when I talk to advisors, obviously it's a much, much smaller level, 50, 60, 70 clients that I earn from. Now, one of the things that the regulator's been doing recently is they wrote a recent asset management paper where they've been looking to put pressure on asset managers and talking about price and value. Okay. Now, in relation to that, what that means is that they're saying the value that you give, the key measure that they're looking towards is the price. Now, one of the things that we do at True Potential is in our asset management, we've always driven down the cost of what asset managers have done. But that aside, what it does in relation to these situations is that we believe that the regulator is going to move on and focus at financial advisors, price and value, and what's being given in relation to that. And that potentially poses a challenge where we've reduced down our client bank, because what this means is we may need to reduce our costs. Let me put that in context. The regulator could take the following view. I've got a client with £1 million assets under management, and I charge him 0.5 ongoing. For that, I receive £5,000. I have another client who has £250,000 assets under management, and that client I charge 0.5 ongoing. There is a disparity of £3,750 between those two customers and what they're paying. A regulator might ask, what is the additional value that you are delivering to the £1 million customer that means that you can charge £3,750? It's a really, really difficult question to answer, because what we're talking about here is a model where our fees have not changed much from the previous commission model, where most people are doing facilitated charging, and the model's not really changed in relation to that. Now, what that could do, if that was enforced, and there has been leanings in the press that the regulator might look down this route, is it drives down the profitability of advisors, and firms that are requiring turnover from these fees, it drives down their profitability as well in an already struggling sector when it comes to profitability. The key thing that we're trying to do with some of our direct marketing support is engage some of those customers that people haven't spoken to in a little while. I'll give you an example. I had a firm that had 1,000 customers. Why? Well, they're in a situation where over many years they've sold to 1,000 people over a 20-year period, of which 100 customers are now existing customers. And I asked the practice principal of that business, quick question, what is the likelihood that 10% of those 1,000 customers are now in a position where they would actually fit in to your model of being the sort of customers that you want to deal with? Only 10%. Said, quite likely that there could be some great opportunity there. So what we did for that firm is we analysed their business and we came up with a marketing strategy for them through our direct offer approach. And then we communicated that out to try and increase revenues, diversify their business, and maximise their profitability. That's an example of one of the things that we've done for a firm on a direct marketing side. I hope that makes sense. So guys, I'm trying to make it as simple as that. Give them a story around something that's currently in the market, that's important to them, that's a bit of an insight, and then we can then link that back into some of the things that we're doing to get them interested, to then try and get the meeting and demonstrate how we're different than other people. I hope that's helped. Cheers.